Okay, in this video we're going to talk about measuring risk. In this particular we're going to do two things. First thing we'll do is talk about a single individual asset, in which case we'll be calculating something referred to as standalone risk. In addition to that, we will talk about what happens when we create some portfolios. So here we go with the basic idea here is we have three assets that we have investigated, and we have a pretty good idea of what we think is going to happen to these assets over the next, let's say, year, 2 years. Asset A, we have divided the economy of the world into 5 categories. It doesn't matter whether you use all 5 or not. We're only going to use 3. So what we're saying for asset A is if the economy is very good in the next couple of years, we would expect asset A to earn 15%. If it's only an average economy, 5%. In a bad economy, we would expect it to lose 4%. So that is asset A. We've also done the exact same things with assets B and C. Forecasted what we think will happen to returns in moving forward in certain economic conditions. The other thing that we have to add in our model here is some probabilities. What do we think the probability of a good outcome is? Well, we're going to identify that maybe through some surveys to economists, etc. But we're going to create what we refer to here as these probabilities. What's the chance that we'll actually have a good economy? We're saying 35%. What's the average economy? Around 40%. And we figure 25% is a bad economy. And then, of course, at the bottom, these total probabilities have to add up to 1.0. So let's explore. Let me get rid of these numbers because we don't need them right now. Let's explore what happens with these 3 assets with respect to their risk. So asset A, if you were to buy asset A over this time frame, you would expect to earn 6.25%. So the expected return is the same thing as the average rate of return. It's in statistical terms, it's the mean. So 6.25 is what you would expect to get on average. The riskiness is determined by these next 3 categories, these next 3 line items. Variance is the general term. That's the statistical term that's used to measure a bell curve or a normal distribution. But standard deviation is what we usually use to talk about risk with respect to an individual asset. So in this case, asset A has a standard deviation of 7.33%. And essentially what standard deviation does, it measures a distance, the distance from the mean. Statistically, we're talking about it's measuring dispersion. How are things spread out? The more things are spread out, the more likely you're going to get something different than what you expected to happen. And that is the measurement of risk that we're using. Excuse me. Coefficient of variation is a measure of dispersion, but we really only use it when we're making comparisons. So you can see here that the standard deviation of A is 7.3%. The standard deviation of B is 12.52%. They are, obviously B is bigger, but then we want to use, if we really want to compare these, we really should use coefficient of variation. And again, you can see that indeed B is still riskier than asset A. But sometimes that won't be the case. So that's why the coefficient of variation is very nice to use when we talk about comparisons between assets. Range is a measure of statistics, but it's just a very simple measure. It's the highest return minus the lowest return. So you're going to say 15 minus a negative 4 is obviously 19. It's not very statistical. It doesn't take into account the chances that those events will ultimately happen. So what else can we find from this information? Well, asset B, if you look at it, it has a higher rate of return on average. It has a higher standard deviation, a higher coefficient of variation. But how are A and B related to each other? The statistics for relationships are down below here. Covariance measures in general terms how assets relate with each other. You can see here they're either negatively related, or there's only A and B here, or they're positively related. So in this case, we can see that asset A and B are negatively related to each other. We really don't get much more information about that. Correlation, though, utilizes that relationship and gives us more of a power number, if you will. So asset A and B have a correlation of negative 0.94. Now the lowest this number could be is negative 1. So it's very, very close to as low as a negative number as you could possibly get. So again, it's measuring this relationship, if you will, of how powerful are these two things related with each other. Let's look at asset C real quick, and you can see from asset C, it has a 3% of rate of return, but all the other numbers are zeros. That is because it is essentially a risk-free asset. It doesn't matter what happens in the economy, we're predicting that we're going to get the exact same rate of return. So how do you use this spreadsheet? And you need to understand what the probabilities are, and if you have the returns under each one, you just enter them and you will get the solutions. They'll pop up here rather nicely. We can also use this to look at portfolios just as well. So what would happen if we say, look, I would like to put 30% of my money in asset A, and I would like to put 70% of my money in asset B. Now what we're doing is we are creating a portfolio, right? The portfolio statistics are on the far right here. So let's see how this relates out. It'll have a rate of return that's somewhere in between the two because it's an average. But now let's look at statistically what's happening to risk. Variance is 0.45. The standard deviation is less than either one of these two assets, and the coefficient of variation is also less than either one of the individual assets. And what this has described for us is something called diversification. Diversification is the combination of assets that have a relationship that's less than perfectly positively correlated. Perfectly positively correlated would be +1. This is almost -1. So it's on the other continuum of relationships. So what that means is we're going to get a substantial amount of diversification. And what you can see here is by adding these two securities together, we actually get an asset that has less risk than the components within the asset. Now there's one other thing that we want to talk about briefly before we move on, and that is, what does this portfolio look like? If we scroll to the right here, you will find a graph that combines assets A and B, and it creates all the possible portfolios for those two assets, and that is this curvilinear function. So what we would like to do is talk about, well, how would you choose? If you could only choose assets A and B, what portfolio would you want to have? Now this brings into a little bit more of an investments question, but quite frankly, the answer to this depends on you as an individual. Some people like to be a little bit riskier, and some people like to be a little more conservative. So those people that like to be conservative are going to want to be on this upper bar here. They're going to be on this upper line, but they're going to be to the left-hand side here where we have less risk and, of course, lower returns. Those people that want to be riskier, want to be more aggressive, would be further out here in the bar. And of course, they will get higher levels of risk and higher associated levels of return. This bottom half of this curve is really a set of unacceptable assets, because at this risk level, 0.05, this is the portfolio that you could pick down here, but there is a much better portfolio straight up above it. So that's really the portfolio you want, the one that would give you the highest rate of return for a given level of risk. This upper bar here again is referred to as the efficient frontier.